Before we dive in, please remember that this video is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or attorney. The information provided in this presentation is not intended to be a substitute for professional financial, legal, or real estate advice. You should always consult with a qualified professional for advice tailored to your individual situation. You found it. The one. The house with the perfect kitchen island, the backyard that's just begging for a barbecue. In the school district you've been obsessing over for months. Your heart is pounding. This is it. You're ready to make an offer, to start your life in this home. And then you hit the wall. A terrifying 10-foot-high wall of paperwork and confusion called the mortgage. Suddenly words like DTI, escrow, PMI, and ARM are flying at you, and that dream in your head starts to feel like it's a million miles away. If that sounds familiar, you're not alone. A recent study showed that nearly half of all first-time homebuyers feel unprepared for the mortgage process. And a shocking number of them make critical mistakes that cost them thousands, even tens of thousands of dollars. But that is not going to be you. Not after this. Over the next 10 parts, we are going to completely demystify the entire process of getting a mortgage in the United States. This is your playbook, your step-by-step roadmap from confused renter to confident homeowner. We will break down every single stage, from building your financial foundation to the moment you get the keys in your hand. By the end of this series, you won't just understand the process. You will master it. You will walk into a lender's office with the confidence of an expert, armed with the knowledge to secure the best possible loan, save a massive amount of money, and avoid the stressful pitfalls that trap so many others. So let's start at the only place that matters, the beginning. Before you even think about Zillow, before you call a single real estate agent, before you fall in love with a house you can't have, you have to build your foundation. This is stage one, the financial checkup. Think of this as the training camp before the big game. The work you do here, right now, months before you even apply for a loan, will determine everything that follows. It determines if you get approved, how much you get approved for, and most importantly, the interest rate you'll be paying for the next 30 years. The undisputed king of this stage is your credit score. Lenders see this 3-digit number as your financial report card. It's a measure of your trustworthiness, a snapshot of your history of borrowing and repaying money. To a bank, a high credit score screams, "This person is reliable. They pay their bills on time. They are a safe bet." A low score, on the other hand, flashes a giant red warning sign. Now, why does this matter so much? Because your credit score is directly, and I mean directly, tied to your interest rate. And a seemingly small difference in your interest rate can have an absolutely colossal impact on your wallet. Let me show you something that will blow your mind. Let's say you're buying a $400,000 house with a standard 30-year fixed-rate mortgage. If you have an excellent credit score, say 760 or above, you might qualify for an interest rate of 6.5%. Your monthly principal and interest payment would be about $2,528. Over 30 years, the total interest you pay is a little over $510,000. Now let's take the exact same person buying the exact same $400,000 house, but their credit score is just fair. Let's say around 650. That's not a terrible score, but it's not great. Their interest rate might be 7.5%. That 1 percentage point difference doesn't sound like much, right? Wrong. Their new monthly payment is $2,796. That's an extra $268 every single month. But here's the real gut punch. Over the life of that 30-year loan, the total interest they pay is over $606,000. That is a difference of $96,000. Let that sink in. A difference in your credit score, something you have a huge amount of control over, could cost you nearly $100,000. That's a brand new luxury car. That's a college education for your kid. That is the power of your credit score. So your first mission starting today is to know your score and make it as strong as humanly possible. Here's your action plan. First, pull your credit reports. Not from some random website that wants your credit card, but from the official government-authorized source, annualcreditreport.com. You are entitled to a free report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. Get all 3. Second, review them like a detective. Look for errors. A late payment that wasn't late? An account you never opened? It happens more often than you think. And these errors can be devastating to your score. If you find one, dispute it immediately with the credit bureau. Third, focus on the 2 biggest factors that make up your score: payment history and credit utilization. Payment history is simple. Pay every single bill on time every time. One 30-day late payment can drop your score by 50 to 100 points and stay on your report for 7 years. Set up autopay for everything. This is non-negotiable. Credit utilization is a bit more complex, but it's a secret weapon. It's the percentage of your available credit that you're currently using. If you have one credit card with a $10,000 limit and you have a $5,000 balance, your utilization is 50%. Lenders want to see this number below 30% and ideally below 10%. High utilization signals to them that you might be overextended and reliant on debt. Paying down your credit card balances is one of the fastest ways to give your score a significant boost. But your financial checkup isn't just about your credit score. Lenders also look at your entire cash flow situation, and the key metric here is your debt-to-income ratio, or DTI. It's a simple concept. What percentage of your gross monthly income, that's your income before taxes, is already spoken for by debt payments? This includes your rent or current mortgage, car loans, student loans, credit card minimum payments, and any other installment loans. For example, if you make $6,000 a month before taxes, and your total monthly debt payments add up to $2,400, your DTI is 40%. Lenders have a magic number here. Generally, to qualify for the best loans, they want to see your total DTI, including your new potential mortgage payment, at or below 43%. The lower your DTI, the more confident a lender will be that you can comfortably handle a mortgage payment on top of your other obligations. So your second mission is to calculate your DTI, and if it's high, create a plan to pay down debt, especially high-interest loans like credit cards or personal loans. Finally, let's talk about cash. Lenders want to see that you have skin in the game. This means having enough cash saved for 3 critical things: your down payment, your closing costs, which are typically 2 to 5% of the home's purchase price, and cash reserves. This last one is what trips people up. Cash reserves are your safety net. Lenders want to see that after you've paid your down payment and closing costs, you still have liquid cash left in the bank, typically enough to cover 2 to 6 months of your new total mortgage payment. This proves to them that if you lose your job or have a medical emergency, you won't immediately default on the loan. It shows financial stability and responsibility. This entire stage, improving your credit, lowering your DTI, and building your savings, is the unglamorous behind-the-scenes work that separates successful, low-stress homebuyers from the ones who get hit with rejections and terrible loan offers. You are building a financial fortress, and once that fortress is secure, you'll be ready to get the single most powerful tool in a homebuyer's arsenal, which is exactly what we'll cover in the next part: getting pre-approved. This is where the hunt truly begins. Imagine for a moment you're entering a high-stakes auction. The prize is the home of your dreams. Everyone is shouting numbers, waving paddles, but the auctioneer can't even see you. You're invisible. Why? Because you don't have the one thing that proves you're a serious player. You don't have proof you can actually pay. In the world of real estate, that proof is your mortgage pre-approval. It is the single most important document you will get before you ever step foot in an open house. It's not just a piece of paper. It's a golden ticket. It transforms you from a window shopper into a power buyer. Now, you've probably heard the term pre-qualification thrown around. Let's get one thing crystal clear right now. A pre-qualification is not a pre-approval. A pre-qualification is a 10-minute phone call. It's you telling a lender your income, your debts, and what you think your credit score is. Based on that unverified hearsay information, they give you a rough estimate of what you might be able to borrow. Pre-qualification is a guess. It's a maybe. And in a competitive housing market, maybe gets your offer thrown straight into the trash. A pre-approval, on the other hand, is a deep forensic dive into your financial life. It's the lender putting you under a microscope. They don't take your word for it, they demand proof. They verify everything. And when they are finished, they issue a letter, a conditional commitment, stating that they are willing to lend you a specific amount of money at a specific interest rate. This letter tells a seller and their agent 3 critical things. 1, you are serious. 2, you are credible. And 3, you are not going to waste their time. Think about it from the seller's perspective. They've got 2 offers on their table for the exact same price. Offer A is from a buyer with a pre-approval letter from a reputable bank. Offer B is from a buyer with a flimsy pre-qualification printout, or worse, nothing at all. Which offer do you think they're going to take? They will take offer A every single time, because offer A represents a deal that is very likely to close. Offer B represents a massive risk. The deal could fall apart in a week when the buyer discovers they can't actually get the loan they need. For a seller who needs to move, that's a nightmare. Your pre-approval letter is your ultimate weapon of credibility. It's what gets you in the door and what gets your offer to the top of the pile. So, how do you get this golden ticket? You have to walk through the lender's gauntlet of documentation. This is where all the work you did in the last part, organizing your finances, checking your credit, calculating your DTI, pays off. The lender is now going to ask you to prove it all. Get ready to become very familiar with your scanner or the camera on your phone, because you're going to be sending a lot of documents. First, they'll want proof of income. This isn't just your last pay stub. They want to see the whole picture. That means your last 2 years of W-2s from every employer. Why 2 years? Because they're looking for stability and a consistent earnings history. They'll also want your most recent pay stubs, usually for the last 30 days, to confirm your current year-to-date income. If you're self-employed, a freelancer, or have significant commission or bonus income, the requirements are even stricter. You'll need to provide your last 2 years of complete federal tax returns, including all schedules. They are looking for a consistent, predictable pattern of income that they can count on to continue. Next up is proof of assets. This is where you prove you have the cash for the down payment and closing costs. You'll need to provide bank statements for the last 2 to 3 months for every single account you have. Checking, savings, money market accounts, investment accounts like your 401k or brokerage accounts. And here's a crucial pro tip. Lenders are required by law to source and season your funds. Sourcing means they need to know where every dollar came from. If you have a recent large unexplained deposit, say $10,000 that just appeared in your checking account last week, that's a massive red flag for them. Was it a loan from a relative? A cash gift? They need to know, and they will require a paper trail. A gift, for example, will require a signed gift letter from the donor stating the money is not a loan and doesn't need to be repaid. Seasoning means they want to see that the money has been in your account for a period of time, typically at least 60 days. This proves it's your money and not a last-minute, undocumentable loan that adds to your debt load. So if you're planning to move money around or receive a gift, do it well in advance of applying for your pre-approval. Then comes your debt. While the lender will pull your credit report themselves, and yes, this will be a hard pull, which can temporarily ding your score by a few points, but it's necessary. They'll also want you to provide information on any debts that might not be fully reported. This could include alimony, child support, or any private loans. They are going to take all your monthly debt payments, your car loan, student loans, credit card minimums, and stack them up against the income you just proved. They are independently verifying your debt-to-income ratio, the DTI we talked about. This is the moment of truth where the bank's math confirms if you can truly afford the mortgage payment on top of your existing obligations. Finally, you'll need to provide your personal identification, a copy of your driver's license, your social security number, the basics to prove you are who you say you are. Once you've submitted this mountain of paperwork, you wait. But what's happening behind the curtain? The loan officer isn't just putting these documents in a folder. They are packaging your entire financial life and running it through sophisticated automated underwriting systems, or AUS. The two big ones are Fannie Mae's Desktop Underwriter, or DU, and Freddie Mac's Loan Product Advisor, or LPA. These systems are the gatekeepers. They analyze your credit score, your DTI, your assets, your loan-to-value ratio, and in a matter of minutes they spit out a decision. Approve/eligible, refer/caution, or ineligible. An approve/eligible is what you're hoping for. It means the computer, based on all the data, sees you as a solid borrower who meets the guidelines. A refer/caution means the computer is on the fence. It's not a no, but it means a human underwriter needs to manually review your file to make a judgment call. This is where having a clean, well-documented file makes all the difference. If all goes well, a few days later you'll get the call. You're pre-approved, and shortly after, you'll receive that official pre-approval letter. It will state the maximum loan amount you're approved for, the loan program like a conventional 30-year fixed, an FHA loan, etc., and often a locked-in interest rate that's good for 60 to 90 days. This letter is your license to hunt. Now, a few critical words of warning. First, your pre-approval is not a blank check, and it's not a commitment to a specific lender. You should absolutely shop around. Get pre-approved with 2 or 3 different lenders, a big national bank, a local credit union, and a mortgage broker, to compare rates and fees. The impact of multiple hard credit pulls for a mortgage within a short window, typically 30 days, is usually bundled together and treated as a single inquiry, so it won't wreck your score. Shopping for a mortgage is one of the single best ways to save thousands, even tens of thousands of dollars over the life of your loan. Second, and this is the most important rule of all, once you are pre-approved, you must enter a financial lockdown. Your pre-approval is a snapshot of your finances at a specific moment in time. The lender has approved that version of you. Do not change anything. Do not quit your job or change careers. Do not buy a new car. Do not co-sign a loan for your cousin. Do not open new credit cards. Do not even buy furniture for your future house on credit. Any significant change to your income, your assets, or your debt can invalidate your pre-approval in a heartbeat. The lender will re-pull your credit and re-verify your employment right before closing. And if something has changed for the worse, they can and will deny your final loan, even on the day you're supposed to get the keys. Protect your pre-approval like it's a fragile artifact. You've built your financial fortress. You've survived the gauntlet of documentation and secured your pre-approval letter. You are now officially a power buyer, ready to be taken seriously by the entire real estate world. You have the key, but a key is useless if you don't know which doors to open. You need a guide, an expert navigator for the wild, confusing, and often treacherous world of the housing market. You need a great real estate agent. And finding the right one is an art form, because the person you choose to represent you can make or break your entire home buying journey. That's exactly where we're heading next. Think of it like this. If buying a house is like climbing Mount Everest, your mortgage pre-approval is your oxygen tank. It's essential, but it doesn't get you to the summit. For that, you need a Sherpa, an expert guide who knows the terrain, anticipates the dangers, and has your back when the weather turns. In the world of real estate, that guide is your agent. And a mediocre one can leave you stranded on the side of the mountain, while a great one will lead you to the peak. So what separates the great from the good, or even the bad? A great real estate agent is so much more than a person with a keycard who unlocks doors. They are your strategist, your negotiator, your neighborhood encyclopedia, and sometimes your therapist. Their job is to be your fiduciary. That's a fancy word, but it has a very simple, powerful meaning. They are legally and ethically bound to act in your best interest, and your best interest alone. They analyze market data to make sure you're not overpaying. They have a network of trusted professionals, home inspectors, lawyers, contractors, that you can tap into. They understand the intricate dance of making an offer, the counteroffer, the contingencies. They can spot red flags in a property listing that you would scroll right past. They are the buffer between you and the seller's agent, whose sole job is to get the highest possible price for their client. And that brings up a critical distinction. You need a buyer's agent. When you see a house listed online, the agent whose name is plastered all over it is the listing agent or seller's agent. They work for the seller. Their loyalty is to the seller. If you call them directly, they might be happy to show you the house, but they are not on your team. You need your own representation. An agent whose entire mission is to get you the best possible outcome. So, how do you find this real estate MVP? This isn't a time to just Google real estate agent near me and pick the first one with a nice headshot. This is a job interview, and you are the hiring manager for one of the most important positions in your financial life. Your search should start with referrals. Talk to friends, family, and coworkers who have recently bought a home in your area. Ask them not just who they used, but why they loved them. What specifically did the agent do that made the process better? Did they win a bidding war? Did they negotiate a huge repair credit after the inspection? Did they talk them out of a bad house? That last one is a huge sign of a great agent. An agent focused on a commission wants to close a deal, any deal. An agent focused on you wants to close the right deal. Once you have a few names, your interview process begins. Yes, you need to interview at least 3 agents. Don't feel bad about this, the pros expect it. This is your chance to gauge their expertise, their communication style, and their personality. You're going to be spending a lot of time with this person, often in stressful situations. You need to know you can work well together. So what do you ask? Forget the softball questions. You need to get specific. First question. How many buyers have you personally represented in the last 12 months, specifically in the neighborhoods I'm interested in? This question does 2 things. It weeds out the part-timers who only sell a few houses a year. You want a full-time professional who lives and breathes this market. Second, it tests their hyper-local knowledge. An agent who is a top seller across the entire state might know nothing about the specific pocket you're looking at. You want the agent who knows which streets have drainage issues, which school districts are overrated, and which new coffee shop is about to make a neighborhood pop. Second question. Walk me through your process for a new buyer. From our first meeting to the day I get the keys. A great agent will have a system. They'll talk about an initial consultation to understand your needs, how they set up property searches, how they schedule tours, their strategy for writing offers, how they manage the process after an offer is accepted. If they stumble or give you a vague answer like, "Well, we just go look at some houses," that's a red flag. You're looking for a project manager, not just a tour guide. Third, and this is a big one, how will you advise me in a multiple offer situation? In today's market, this isn't a hypothetical. It's a probability. You don't want an agent who just says, "You'll have to offer more money." A top-tier agent will talk about strategy. They'll discuss escalation clauses, appraisal gap coverage, shortening contingency periods, and other creative ways to make your offer stand out that don't always involve a higher price. They'll also know when to advise you to walk away, to not get caught up in the frenzy and overpay. Fourth question. What is your preferred method of communication? And what is your typical response time? This is all about setting expectations. If you're someone who needs instant text message replies and they only check their email twice a day, it's not going to be a good fit. There's no right answer here, only what's right for you. But a professional should be able to get back to you in a timely manner, especially when a deal is on the line. Finally, ask for references. And don't just ask for them, actually call them. Ask their past clients what their biggest challenge was during the process, and how the agent helped them overcome it. As you're interviewing, you also need to be on the lookout for massive red flags. If an agent seems more interested in your pre-approval amount than your actual needs and wants, run. Their goal should be to find you the right home, not the most expensive home you can afford. If they pressure you ever, that's a deal breaker. An agent who uses phrases like "you need to decide now or it'll be gone" is using sales tactics, not advisory strategies. A great agent provides you with all the information and empowers you to make a calm, rational decision. Another red flag is an agent who is a yes man. If you say you love a house with a cracked foundation and a leaky roof, a good agent shouldn't say, "Great, let's write an offer." They should say, "I see why you love the layout, but let's talk about what it would cost to fix these structural issues." They need to be the voice of reason, not just your cheerleader. Once you've found the one, the agent who is experienced, strategic, communicative, and who you genuinely connect with, you'll likely be asked to sign a buyer-broker agreement. This can feel intimidating, but it's a standard document that formalizes your relationship. It's a contract that says this agent is officially working for you, and you agree to work exclusively with them for a set period of time, usually a few months. Read it carefully. It will outline the agent's duties to you and your obligations to them. It will also explain how the agent gets paid. In the vast majority of transactions in the United States, the buyer's agent commission is paid by the seller from the proceeds of the sale. So this world-class expertise and representation typically comes at no direct, out-of-pocket cost to you as the buyer. That might be the single best deal in the entire home buying process. Choosing your agent is a monumental decision. It sets the tone for everything that follows. Take your time, do your homework, and trust your gut. This person will be your advocate, your protector, and your guide through one of the most complex and emotionally charged transactions of your life. Now that you've assembled your dream team, your lender who has your finances locked down, and your superstar agent who knows the market like the back of their hand, the real fun begins. It's time to hit the streets. It's time to start the hunt for your home. And that process is way more than just scrolling through Zillow and saving pretty pictures. It's a strategic game of wants versus needs, of compromise versus deal breakers, and that's exactly what we're breaking down next. So let's talk about that strategic game. You've got your pre-approval letter in hand. It feels like a golden ticket, a license to dream. You start picturing yourself on that perfect porch in that ideal kitchen. But this is the exact moment where the romantic, HGTV-fueled fantasy of home buying smacks right into the cold, hard reality of the market. This stage, the actual house hunt, is less about finding a dream and more about finding the right compromise. It's an emotional marathon, not a sprint, and the first step isn't opening a real estate app. It's finding your guide, your coach, your market navigator, a top-notch real estate agent. Now, I know what some of you are thinking. In an age of Zillow, Redfin, and a million other websites, do I really need an agent? Can't I just do it myself? The short answer is, you could, but you absolutely shouldn't. A great buyer's agent is your single most valuable asset in this entire process, and here's the best part. Their commission is typically paid by the seller, so their expertise costs you, the buyer, nothing out of pocket. Think of it this way. A good agent doesn't just unlock doors to houses. They unlock information. They know which neighborhoods are about to pop and which have peaked. They know that the house on Elm Street has foundation issues because they saw it with another client last year. They know the listing agent on that corner colonial is notoriously difficult to negotiate with. They have access to the multiple listing service, the MLS, which is the most up-to-date and accurate source of listings, often before they hit the big public websites. They are your shield against overpaying and your sword in negotiations. So how do you find this real estate superhero? Don't just Google realtor near me and pick the first paid ad. Start with referrals. Ask friends, family, and coworkers who recently bought a home and had a fantastic experience. Who did they use? Why were they great? Once you have a few names, you need to interview them. Yes, interview them. You're hiring someone for one of the biggest financial decisions of your life. Ask them tough questions. How long have you been an agent? How many buyers did you help last year specifically in this neighborhood and price range? What's your communication style? Are you a full-time agent? You want someone who lives and breathes this market, not someone doing it as a side hustle on weekends. Pay close attention to how they listen. Do they ask you questions about your life, your commute, your family, your goals? Or do they just start sending you a flood of random listings? A great agent is a matchmaker, not a salesperson. They're trying to understand your life to find a property that fits it. A huge red flag is an agent who tries to push you to look at homes above your pre-approved budget. Their job is to respect your financial boundaries, not stretch them. Find someone you genuinely connect with and trust because you're going to be spending a lot of time with them, often in stressful situations. Once you have your agent, your next job is to get brutally honest with yourself. This is the wants versus needs conversation. I want you to literally take out a piece of paper or open a spreadsheet and make 2 columns: must-haves and nice-to-haves. Must-haves are your non-negotiables, your deal breakers. If a house doesn't have these, you don't even bother looking at it. This could be things like a minimum of 3 bedrooms, a location within a 30-minute commute to work, a specific school district, a fenced-in yard for your dog, or a first-floor primary bedroom for an aging parent. These are the foundational pillars of your search. Be specific, but also be realistic. A 5-bedroom house with a pool on a 1-acre lot for $100,000 in a major city isn't a must-have. It's a fantasy. Your pre-approval amount and your target market will dictate the realm of possibility here. Then you have the nice-to-haves column. This is where you can dream a little. A gourmet kitchen, a finished basement, a 2-car garage instead of 1, hardwood floors, a walk-in closet. These are the features that would be amazing, but you could live without them if the house is otherwise perfect. This list is your guide to compromise. Maybe you find a house that checks every single one of your must-have boxes, but it has a dated kitchen. Is that a deal breaker? Or is it an opportunity to build sweat equity down the road? Understanding the difference between a foundational need and a cosmetic want is the key to avoiding frustration and analysis paralysis. With your agent on board and your list in hand, the real hunt begins. You'll start getting listings, going to open houses, and scheduling private showings. And here's a pro tip: look past the staging. Sellers will hire professionals to make a house look incredible. They'll use smaller furniture to make rooms feel bigger, bake cookies to make it smell like home, and paint everything a neutral grayish. Your job is to be a detective, to look at the bones of the house, not the throw pillows. Pay attention to the big-ticket items. How old is the roof? Look for curling or missing shingles. What's the condition of the HVAC system? Check the inspection sticker for its age. Are the windows old and drafty, or have they been updated? In the basement, look up. Do you see any signs of water stains on the subfloor above? Give the faucets a turn and flush the toilets to check the water pressure. Flip on light switches. You're not a home inspector, but you're looking for obvious red flags that could mean thousands of dollars in immediate repairs. And prepare for the emotional roller coaster. You will walk into a house and feel deep in your gut, this is it. This is the one. You'll start mentally arranging your furniture, and then you'll find out it has a major issue, or you'll get into a bidding war and lose. It can be crushing. You will also walk through a dozen homes that are just fine, nothing special. You'll start to feel discouraged, wondering if you're being too picky or if your perfect house even exists. This is normal. This is part of the process. Trust your agent's guidance and stick to your must-haves list. The right house will come along. And woven through all of this is the golden rule of real estate. Location, location, location. You can change almost anything about a house: the paint, the kitchen, the floors. You can even knock down walls. But you can never ever change its location. Don't just look at a house during a Saturday open house. Drive by it on a Tuesday morning at 8 a.m. to see what the commute traffic is really like. Visit on a Friday night to see if the neighborhood is quiet or a party zone. Look up the school ratings, even if you don't have kids, because it massively impacts your home's future resale value. Check out the proximity to grocery stores, parks, and highways. Is there a new development plan nearby that could bring more traffic or, conversely, more amenities? You aren't just buying a structure of wood and drywall. You're buying a piece of a community, and you need to make sure it's one you actually want to live in. After weeks or sometimes months of searching, of swiping, of walking through other people's lives, it happens. You walk into a house and it just clicks. Checks the must-have boxes. It has a few of the nice-to-haves. You've looked at the bones, you vetted the location, and your gut and your head are in agreement. You turn to your agent and say the 5 words that change everything. I want to make an offer. And just like that, you've transitioned from a house hunter to a potential home buyer. The game is about to change entirely. You're moving from the world of looking and dreaming to the high-stakes arena of contracts, negotiations, and deadlines. Making an offer isn't just about naming a price. It's a strategic proposal designed to win you the house, and getting it wrong can cost you everything. This contract, this offer, is your battlefield. And your weapons are not just dollars and cents, but clauses, conditions, and dates. Let's break down the anatomy of a winning offer, because this is where dreams are either secured or shattered. First, the most obvious component, the price. This isn't just a number you pull out of thin air. It's a calculated strike. Your real estate agent is your general here. They'll run what's called a comparative market analysis, or CMA. They're looking at comps, recently sold, similar homes in the same neighborhood. This is your reality check. It tells you what the market has been willing to pay for a house just like the one you want. But that's just the starting point. You have to ask, is it a buyer's market or a seller's market? In a buyer's market, where there are more houses than buyers, you have leverage. You might offer below the asking price. But in a seller's market, the kind we've seen in many parts of the country recently, it's a feeding frenzy. Offering below asking is like bringing a knife to a gunfight. You'll be laughed out of the room. In these situations, you often have to offer at or even above the asking price just to be considered. This is where psychology comes in. Sometimes, offering a slightly odd number, like $503,000 instead of a flat $500, can make your offer stand out. It suggests you've been very precise in your calculation. In a multiple offer situation, your agent might suggest an escalation clause. This is a powerful tool. It basically says, I'll pay X amount for the house, but if someone offers more, I'm willing to beat their offer by, say, $2,000, up to a maximum price of Y. It's like setting up an automatic bidding system, ensuring you don't lose by a tiny margin, but it also protects you from overpaying wildly. The key is that it shows the seller your absolute top dollar, which can be a risk. But in a bidding war, calculated risks are what win the day. Now let's talk about the single most important part of the offer for your protection: contingencies. Think of these as your escape hatches. They are conditions that must be met for the sale to go through. If they're not met, you can walk away from the deal and, crucially, get your deposit back. There are 3 major contingencies you absolutely need to understand. First is the inspection contingency. This gives you a set period of time, usually 7 to 14 days, to have a professional home inspector come in and scrutinize the property from foundation to roof. They'll give you a detailed report on everything that's wrong with the house, and trust me, there's always something. If the inspection reveals major issues like a cracked foundation or a failing roof, this contingency allows you to do one of 3 things. Ask the seller to make the repairs, ask for a credit to cover the cost of the repairs, or if the problems are just too big, walk away from the deal entirely. Without this clause, you buy the house as is. You find a $10,000 termite problem the day after you move in? That's your problem now. The inspection contingency is your shield against buying a money pit. Second is the appraisal contingency. This one is for your lender, but it protects you. After your offer is accepted, your lender will hire a professional appraiser to determine the home's fair market value. Why? Because the bank will only lend you money based on that appraised value, not the price you agreed to pay. Let's say you offer $400,000 for a house, but the appraiser comes back and says it's only worth $380,000. This is called an appraisal gap. Without an appraisal contingency, You are contractually obligated to come up with that extra $20,000 in cash to make up the difference. Most people don't have that just lying around. The appraisal contingency lets you back out of the deal if the home doesn't appraise for the purchase price, or it gives you leverage to go back to the seller and renegotiate the price down to the appraised value. Third, and perhaps the most critical, is the financing contingency, also known as the mortgage contingency. This clause states that the purchase is conditional on you successfully securing a mortgage. You've been pre-approved, yes, but pre-approval is not final approval. The underwriter could find something in your final review. You could lose your job. Anything could happen. If your loan falls through at the last minute and you don't have this contingency, the seller can sue you for breach of contract and, at a minimum, they will keep your deposit. This contingency is your ultimate financial safety net. Now you might be thinking, great, I'll just load up my offer with every contingency possible. Not so fast. Remember that seller's market? In a bidding war, an offer with fewer contingencies is much more attractive to a seller. It means less risk and a higher certainty of closing. This is where the gut-wrenching decisions are made. Some buyers, in a desperate attempt to win, will waive some or all of their contingencies. Waiving the inspection contingency is the riskiest move of all. It's like playing poker blind. Waiving the appraisal contingency means you're guaranteeing you have the extra cash to cover any gap. It's a high-risk, high-reward strategy that can make your offer shine, but it can also lead to financial ruin if you're not prepared. This is a conversation you must have in depth with your agent, weighing your risk tolerance against the competitiveness of the market. Beyond price and contingencies, there are other key terms. You'll need to put down an earnest money deposit, or EMD. This is a good faith deposit you make when you sign the contract, typically 1 to 3% of the purchase price. It's held in a neutral third-party account called escrow. It's not an extra fee. It gets credited toward your down payment at closing, but its purpose is to show the seller you are serious, you have skin in the game. If you back out of the deal for a reason not covered by a contingency, you forfeit that money to the seller. A larger earnest money deposit can signal to the seller that you are a strong, committed buyer. Finally, you'll propose a closing date. This is the day you officially take ownership of the house. A typical closing is 30 to 45 days out, giving enough time for the inspection, appraisal, and final loan underwriting. Here's another strategic advantage. Find out what the seller wants. Do they need to close quickly to move for a new job? Or do they need more time to find their next home? Being flexible on the closing date can sometimes be more valuable to a seller than a few extra $1,000s. It's a non-monetary way to make your offer stand out from the crowd. So you and your agent have crafted the perfect offer. You've analyzed the comps, decided on a strategic price, carefully selected your contingencies, and determined your earnest money and closing date. The document is drawn up, pages and pages of legal jargon that represent your shot at this new life. You sign it electronically. Your agent hits send. And then the silence begins. The offer is out of your hands, sitting in the seller's inbox. Every phone buzz makes your heart leap. You refresh your email 1,000 times. This is the waiting game. A period of intense anxiety and anticipation that can last anywhere from a few hours to a few days. You've played your hand, and now all you can do is wait to see if the seller will accept, reject, or, as is often the case, come back with a counteroffer, initiating a whole new round of high-stakes negotiations. And that counteroffer, that back and forth, is the heart of the deal. It's a delicate dance of numbers and terms, where every concession feels like a victory and every refusal feels like a setback. Your agent is your champion here, your strategist, translating your goals into the language of real estate contracts. You might go back and forth once, or you might go back and forth 5 times. You might haggle over the price, the closing date, or who pays for which closing costs. You might even ask for the seller to leave that beautiful dining room chandelier. It's all on the table. But then it happens. After the tension, the waiting, the endless refreshing of your email, you get the news. An agreement has been reached. Both you and the seller have signed on the dotted line. A wave of relief and exhilaration washes over you. You did it. You got the house. Well, sort of. This is where so many first-time buyers get confused. Getting your offer accepted is not the finish line. It's the starting gun for the most critical and complex phase of the entire process. You are now officially under contract, or as it's called in some states, in escrow. Think of it like this. The house is now in a protected bubble. It's off the market. The seller can't accept another offer. You can't just go put an offer on another house. You and the seller are now locked into a legally binding agreement to move towards a final sale. This period, typically lasting anywhere from 30 to 60 days, is when the real work begins. It's the time for you, your lender, and a whole new cast of characters to perform what's called due diligence. It's your chance to make absolutely sure this house is what you think it is, and for your lender to make absolutely sure this loan is a sound investment for them. The moment you go under contract, your mortgage journey kicks into high gear, and your team expands. You've had your real estate agent and your loan officer. Now meet the new players. First, there's the escrow officer or closing attorney. This is a neutral third party whose job is to hold all the money and documents securely until every single condition of the contract is met. They're like the referee of the transaction, ensuring a fair and legal exchange. Then you have the title company. Their job is to investigate the property's history to make sure the seller has the legal right to sell it to you, free and clear of any hidden claims. We'll dive deeper into that in a moment. And finally, you have the specialists you'll be hiring, the home inspector and the appraiser. These two roles are absolutely crucial, and they are constantly confused with each other, but they do two completely different things. So the contract is signed. What's the very first tangible step? It's time to put your money where your mouth is. This is the earnest money deposit. This is your good faith deposit. It's a check you write, typically for 1% to 3% of the purchase price, that gets deposited with the escrow company. So on a $400,000 house, you're writing a check for somewhere between $4,000 and $12,000. This isn't an extra fee. This money will be applied toward your down payment and closing costs at the end. But for now, it serves as proof that you are a serious, committed buyer. It also acts as the seller's protection. If you just decide to walk away from the deal for a reason that isn't covered by the contract, you could lose that deposit. It's the skin you have in the game, and it's why understanding the next part is so important. I'm talking about your contingencies. Your purchase contract is filled with them. A contingency is basically a clause that says, I will buy this house if this specific condition is met. These are your escape hatches. They are your legal, contractual ways to back out of the deal and, most importantly, get your earnest money back if something goes wrong. And the first and most important contingency is the home inspection. The inspection period is your window of opportunity to bring in a licensed professional to examine the house from top to bottom. This is not a pass or fail test. The inspector isn't there to tell you whether you should buy the house. They are there to give you data. They are your private investigator, creating a detailed report on the condition of the home's major systems. They'll climb on the roof, crawl through the attic and crawl spaces, check the foundation, test the electrical outlets, run the plumbing, inspect the HVAC system, and look for any signs of water damage, pests, or structural issues. They will give you a comprehensive report, often dozens of pages long with photos and detailed notes, outlining every single flaw they find, big or small. And I promise you they will find things. No house is perfect, not even brand new construction. The key is to distinguish between minor cosmetic issues, a scuffed wall or a leaky faucet, and major systemic problems, a cracked foundation, a failing roof, or outdated electrical wiring. This report is pure gold. It gives you incredible leverage. If the inspection uncovers significant problems you weren't aware of, you typically have three choices based on your contract. 1. You can accept the house as is, knowing you'll have to deal with the repairs yourself. 2. You can terminate the contract, walk away, and get your earnest money back because the inspection contingency was not satisfied. Or 3, and this is the most common outcome, you enter a new round of negotiations. You can go back to the seller with the report and say, we need you to fix these specific items before we close, or more commonly, we've gotten estimates for these repairs, and we need you to provide a credit of X thousand dollars at closing so we can handle them ourselves. While you're busy with the inspection, your lender is ordering the next critical piece of the puzzle, the appraisal. This is where the confusion often sets in. The inspection is for your benefit. The appraisal is for the lender's benefit. The bank is about to give you hundreds of thousands of dollars, and they need to be absolutely certain that the asset they're securing that loan against, the house, is actually worth the money. A licensed appraiser will visit the property to determine its fair market value. They don't do a deep dive like an inspector. They measure the square footage, note the number of bedrooms and bathrooms, assess the overall condition, and look at the quality of finishes. But most importantly, they compare your house to comps, recently sold, similar properties in the immediate area. They're looking for hard data to justify the price you've agreed to pay. This is one of the most nerve-wracking moments of the entire escrow period. Because what happens if the appraisal comes in low? Let's say you agreed to buy a house for $500,000, but the appraiser determines it's only worth $480,000. This creates what's called an appraisal gap. The bank will only lend you money based on the appraised value, not the sales price. So in this case, they will only base their loan on the $480,000 value. You are now short $20,000. Again, you have three options. 1. You can try to negotiate with the seller to lower the price to the appraised value of $480,000. 2. You can come up with the $20,000 difference in cash yourself, on top of your existing down payment and closing costs. Or 3. If you have an appraisal contingency in your contract and can't come to an agreement, you can walk away from the deal and get your earnest money back. A low appraisal can be a deal killer, and it's a moment of pure stress for every buyer. At the same time all of this is happening, the title company is doing its own deep dive investigation. They are performing a title search. Think of it like a background check or a Carfax report for the property. They are scouring public records, sometimes going back 50 years or more, to create a chain of title. They're looking for any red flags. Are there any outstanding mortgages or liens on the property from contractors who were never paid? Are there any unpaid property taxes? Are there any weird ownership claims like a long-lost heir from a previous owner who might have a right to the home? They are making sure that the person selling you the house is the one and only true owner, with the absolute right to sell it. Once they've determined the title is clean, they will issue a title insurance policy. This is a one-time fee you pay at closing, but it's a policy that protects you for as long as you own the home. If, years down the road, someone comes out of the woodwork with a legitimate claim to your property from before you bought it, the title insurance company will defend your ownership in court and cover the financial losses. It is non-negotiable, and it is one of the most important protections you can have as a homeowner. So you have inspections happening, appraisals being ordered, and title searches being conducted. It's a flurry of activity, a carefully choreographed dance of deadlines and documents. All of these pieces are moving in parallel, all designed to protect both you and the lender before the final transfer of ownership. And while all of this external due diligence is going on, your loan file, which has been sitting in a state of pre-approval, is now being moved into the most intense and scrutinized stage of the entire mortgage process. It's being handed over to a person you will never speak to, but who holds the ultimate power over your homeownership dreams, the underwriter. This single, anonymous individual is about to become the most important person in your financial life. They are the gatekeeper. Their job isn't to help you buy a home. Their job is to protect the lender's money. They are a risk analyst, a financial detective, and the final judge, jury, and executioner of your loan application. They will dig through every corner of your financial history with a single question in mind. If we lend this person hundreds of thousands of dollars, what is the statistical probability that they will pay it back on time every single time for the next 30 years? To answer that question, they put your entire file through an intense process, a gauntlet known simply as underwriting. And it all boils down to what the industry calls the 3 C's: capacity, credit, and collateral. Think of these as the 3 pillars that your entire loan application rests upon. If even one of them is weak, the whole structure could come crashing down. Let's start with the first and arguably most important pillar: capacity. This is your ability to repay the loan. The underwriter isn't interested in your future potential or your verbal promises. They want cold, hard, documented proof that you have enough consistent income to handle the proposed mortgage payment on top of all your other existing debts. Your debt-to-income ratio, or DTI, is the key metric here. The underwriter will calculate 2 versions of it. The first is the front-end ratio, which is just a proposed new housing payment. That's principal, interest, taxes, and insurance, divided by your gross monthly income. Lenders generally want to see this number below 28 to 31%. But the one they scrutinize even more is the back-end ratio. This takes your total housing payment plus all your other monthly debt obligations, your car loan, your student loans, your credit card minimum payments, and divides that total by your gross monthly income. For most conventional loans, the absolute maximum they can stomach is around 43%, though some government-backed loans might stretch to 50% in very specific circumstances. To the underwriter, your DTI isn't just a number. It's a measure of your financial breathing room. If it's too high, they see a borrower who is stretched thin. Someone who is one unexpected car repair or medical bill away from a financial crisis and a potential default. So how do they verify this? They will review every pay stub you submitted, looking for consistency. They'll pore over your last 2 years of W-2s and tax returns, Searching for a stable and predictable earnings history. Are you a salaried employee who's been at the same job for 5 years? That's a gold star. Are you a commission-based salesperson, a freelancer, or a small business owner? The underwriter's magnifying glass comes out. They'll see your fluctuating income as a higher risk, and they'll demand more proof. Typically a full 2 years of tax returns and a year-to-date profit and loss statement, to average out your earnings and ensure they're sustainable. Then comes the final check. The verification of employment, or VOE. Yes, they will literally call your employer's HR department, often just days before closing, to confirm you are still employed and to verify the income you stated. This is why we tell every single client, do not, under any circumstances, quit or change your job in the middle of the mortgage process without talking to your loan officer first. To an underwriter, a last-minute job change is a massive red flag that can halt the entire process. Once they're satisfied you have the capacity to pay, they move to the second pillar, credit. This isn't about how much money you make. It's about your character. It's a measure of your willingness to repay your debts. Your credit score is the headline, but the underwriter reads the entire article. They will pull a detailed tri-merge credit report, combining data from all 3 major bureaus, Equifax, Experian, and TransUnion, and they will read it like a biography of your financial life. They're looking for a consistent pattern of responsible behavior. Do you pay your bills on time? A single 30-day late payment on a car loan from a year ago can require a formal letter of explanation. Multiple late payments can be a deal killer. How much of your available credit are you using? High balances on credit cards signal to an underwriter that you might be living beyond your means. How long is your credit history? A long history of on-time payments is a powerful indicator of future performance. What if your history isn't perfect? What if you have a collection account from an old utility bill? Or even something more serious like a past bankruptcy or foreclosure? It's not necessarily an automatic denial, but you're going to have to explain it. The underwriter will require a signed letter of explanation, or LOX, detailing the circumstances that led to the issue and what steps you've taken to reestablish good credit since. They are looking for context. Was it a one-time crisis like a medical emergency or a pattern of financial mismanagement? Your story and the documentation to back it up matters immensely. After scrutinizing you, the underwriter turns their attention to the final pillar, collateral. This is the house itself. The lender is about to place a massive bet on this property, and the underwriter needs to be certain it's a good one. The house is the ultimate safety net. If you stop paying, they can foreclose and sell the house to recoup their investment. But that only works if the house is actually worth what you're paying for it. This is where the appraisal comes in. The underwriter will order an appraisal from a licensed, third-party appraiser who has no connection to you, the seller, or the real estate agents. This appraiser will inspect the property, measure it, note its condition, and compare it to at least 3 similar homes that have recently sold in the immediate area. Their final report provides an independent, professional opinion of the property's market value. The underwriter reviews this report with a fine-toothed comb. Does the value support the loan amount? If you're buying a house for $400,000, but the appraisal comes in at only $380,000, you have a problem. The lender will only lend based on the lower of the 2 values. This appraisal gap creates a $20,000 shortfall that has to be covered. You can try to renegotiate the price with the seller. You can bring an extra $20,000 in cash to closing, or if your contract allows, you can walk away from the deal. Beyond the value, the underwriter also checks for any health and safety issues noted by the appraiser. Things like a leaky roof, broken windows, or exposed wiring. They'll also review the title search to ensure there are no hidden liens or ownership claims on the property. And they'll require proof that you've secured a homeowner's insurance policy. They need to know their asset is protected from the moment you take ownership. After this exhaustive review of your capacity, credit, and collateral, the underwriter makes a decision. The best case is a clear to close, meaning you're fully approved. But the most common outcome is a conditional approval. This is fantastic news. It means the underwriter is ready to approve your loan if you can satisfy a few final conditions. These conditions are typically requests for more documentation. It could be your most recent pay stub that just came out, an explanation for a large, non-payroll deposit in your bank account, or a final signed document you missed. This is the final sprint. Your loan officer will send you this list of conditions, and your job is to get them everything they need as fast as humanly possible. Every day you delay is another day you're not closing on your home. You respond quickly, your loan officer submits the conditions back to the underwriter for a final review. And then you wait for the 3 most beautiful words in the entire home buying process: clear to close. Once you have that final, unconditional approval from underwriting, the gears shift. The frantic document gathering is over. The intense scrutiny is finished. Now the process moves from proving your worthiness to preparing the mountain of final legal documents that will actually transfer ownership of the property and formalize your debt, leading you to the closing table. This is the final leg of the marathon. You've been poked, prodded, and financially x-rayed. You've proven your case. Now you're no longer on trial. You're preparing for the ceremony. And the first major event in this final chapter is the arrival of a critical document: the closing disclosure, or CD. Think of the loan estimate you received at the very beginning as the menu with the estimated prices. The closing disclosure is the final, itemized bill. It's the document that says, here is exactly what you are paying, to whom you are paying it, and what you are getting in return. By federal law, you must receive this document at least 3 full business days before your scheduled closing date. This isn't a suggestion, it's your right. It's called the 3-day review period, and it is one of the most powerful consumer protections in the entire process. Its purpose is to prevent surprises at the closing table. It forces the lender to give you time to review, question, and understand every single number. When that CD arrives in your inbox, drop everything. Print it out. Pull up that original loan estimate you saved and put them side by side. You are now an auditor. Go line by line. Is the loan amount correct? Is the interest rate the one you locked in? Are the origination charges what you expected? Some fees can change slightly, like prepaid interest, but many others, like the lender's application or underwriting fees, cannot change at all unless there was a valid change in circumstance. If you see a new, mysterious fee you've never heard of, or if a number is drastically different from what you were quoted, you pick up the phone immediately. You call your loan officer and you ask, "What is this? Explain it to me." This 3-day window is your time to resolve discrepancies, not on the day of closing when you're under pressure. And be aware, if there are significant changes to the loan after you receive the CD, like a change in the loan product, the APR increases by more than a tiny fraction, or a prepayment penalty is added, the 3-day clock resets. The lender has to issue a new CD, and you get another 3 business days to review. It can delay your closing, but it ensures you are never ambushed. While you're scrutinizing the final numbers, another crucial event takes place: the final walkthrough. This usually happens 24 to 48 hours before closing. This is not a time to show your parents the new living room. This is your last chance to inspect the property and ensure it's in the condition you agreed to buy it in. You're checking for 2 main things. First, is the home in the same physical state as when you last saw it? You're looking for new damage. Did the sellers knock a hole in the wall while moving their couch? Did a pipe burst overnight? Second, and just as important, you're confirming that everything that was supposed to be included in the sale is still there, and everything that was supposed to be fixed has been fixed. Remember those repairs you negotiated after the inspection? You need to see the receipts and visually confirm the work was done. Remember that beautiful chandelier in the dining room, and the custom window treatments that were listed in the contract as included? You need to make sure they haven't been swapped out for cheap replacements. You'd be amazed at the stories. People who skip the final walkthrough only to discover the sellers took the refrigerator, the washer and dryer, and even the smart thermostat, all of which were supposed to stay. The final walkthrough is your last point of leverage. Once you sign those papers, any issues become your problem. If something is wrong, you call your real estate agent from the property right then and there. Okay, the closing disclosure looks good. The walkthrough is complete. The big day has arrived. Closing day. What do you need to bring? First, a valid government-issued photo ID. Your driver's license or passport. Make sure it's not expired. Second, you'll need a pen, maybe 2. You're going to be doing a lot of signing. And third, the big one, your funds to close. This is the final amount listed on your closing disclosure as cash to close from borrower. You cannot bring a personal check for this. It's too much money and the check could bounce. You will need a cashier's check, obtained from your bank, made payable to the title or escrow company, or you will arrange for a wire transfer. Your closing agent will give you very specific instructions for this. Follow them to the letter. Wire fraud is a serious threat, so always verbally confirm the wiring instructions with the title company over the phone using a number you know is legitimate, not one from an email. You'll arrive at the office of a title company, an escrow company, or an attorney. In the room will be a closing agent, maybe your real estate agent, and sometimes the sellers. And in the middle of the table, there will be a stack of documents that looks like the script for a feature-length film. Prepare yourself for the most important and expensive autograph session of your life. For the next hour or so, your primary job is to sign, initial, and date. Your hand will cramp. Your signature will devolve into a scribble. But don't let the sheer volume of paper numb you into complacency. The closing agent will briefly explain each document, but you should know what the most important ones are. There are 3 documents in that stack that form the holy trinity of your home loan. First is the promissory note. This is the simplest but most powerful document you will sign. It is your IOU to the lender. It's your personal promise to repay the money. It states the total amount you borrowed, the interest rate, your monthly payment amount, and where and when to send the payments. It outlines the penalties for late payments and the terms under which the lender can demand you pay the full amount immediately. That's called an acceleration clause. The promissory note is the evidence of your debt. It's a negotiable instrument, meaning the lender can sell it to another investor, which is why your loan might be transferred later on. The second key document is the mortgage, or in some states, the deed of trust. If the promissory note is your promise to pay, the mortgage is the consequence if you don't. This is the security instrument. It's the document that legally ties your promise to pay to a specific piece of property, your new house. It gives the lender a security interest in your home, which means if you default on the loan, if you break the promise you made in the note, the lender has the legal right to foreclose and take possession of the property to recoup their money. This is the document that makes your home the collateral for the loan. So, the note creates the debt and the mortgage secures the debt with the house. You need both to have a mortgage loan. And finally, the third star of the show, the deed. This is the one you've been waiting for. The deed is the legal document that officially transfers ownership of the property from the seller to you. It contains a legal description of the property and is signed by the seller or grantor. When you sign to accept it, you become the grantee. This is your proof of ownership. After you've signed the last page, there's often a slightly awkward pause. You're done, but it's not quite over. The closing agent will now package up your signed loan documents and send them to the lender for a final, quick review. Once the lender confirms everything is in order, they give the clear to close and authorize the title company to release the funds. This is called funding. Wires are sent from your lender to the title company, and the title company then cuts a check or sends a wire to the seller for their proceeds, pays off their old mortgage, and pays all the other parties involved like the real estate agents and the appraiser. Simultaneously, the title company will take that signed deed and send it to the county recorder's office to be officially entered into the public record. This is recording. It's the act that makes your ownership of the property official in the eyes of the law, protecting you against other claims to the property. And then, once the money has moved and the recording is in process, the moment arrives. The closing agent will look up, smile, and slide a small metallic object across the table. The keys. In that moment, the mountain of paperwork, the stress, the endless requests for documents, it all melts away. You pick them up. They feel heavier than you expected. They aren't just pieces of metal. They are the tangible result of months of effort, the symbol of a new chapter, and the key to your front door. You are officially a homeowner. But that feeling, that moment of triumph at the closing table, it's just the beginning of a different kind of journey. The real work and the real reward starts the moment you slide that new key into the lock for the very first time. You turn it. The deadbolt clunks open. You push the door, and it swings into an empty space that is entirely, completely yours. The air inside is still. Your footsteps echo in a way they never did during the showings. This isn't a house you're visiting anymore. This is home. For the first few days or even weeks, you're living on adrenaline. You're painting walls, tearing up old carpet, and figuring out which box has the coffee maker. You're ordering pizza to eat on the floor of an empty living room and dreaming about where the sofa will go. The mortgage, that giant financial anchor you just chained yourself to, it feels distant, like a problem for another day. And then it arrives. An official-looking envelope. It's not a bill, not yet. It's your welcome packet from your mortgage servicer. And right here is the first critical thing you need to understand as a new homeowner. The company you send your check to every month might not be the lender who approved your loan. Lenders often sell the servicing rights to your mortgage. It doesn't change your interest rate, your loan amount, or any terms you agreed to. It just changes the name and logo on the website you log into. So open that packet. Inside, you'll find your new loan number, instructions for setting up an online account, and details about your first payment. Pay close attention to that first payment date, because it's probably not what you think. Most people assume it's due exactly 1 month after closing, but that's almost never the case. Remember all that paperwork at closing? One of those documents was for prepaid interest. You paid the interest for the remaining days of the month you closed in. Mortgages are paid in arrears, meaning you pay for the month you just lived in, not the one you're about to start. So, if you closed on May 15th, you already paid the interest from May 15th to May 31st. Your first full mortgage payment won't be due on June 1st. It will be for the month of June, and it will be due on July 1st. This little bit of breathing room is a gift. Use it wisely. Use it to set up your online account, link your bank, and turn on autopay. Do it right now. Don't wait. The single most important thing you can do for your credit score and your financial health is to never, ever be late on a mortgage payment. Automate it and forget it. Now, while you're waiting for that first real bill, something else will start happening. Your mailbox will begin to overflow. You'll get a flood of letters that look incredibly official. They'll have your name, your new address, your lender's name, and even your loan amount printed on them. They'll use scary language like final notice or important mortgage protection information. They look like they're from your bank, but 99% of them are not. This is the dark side of public records. When you buy a home, the deed is recorded publicly. And a whole industry of third-party companies scrapes that data and immediately targets you. They're trying to sell you something called mortgage protection insurance, which is basically a life insurance policy that pays off your mortgage if you die. They're trying to sell you overpriced home warranties or services to fight your property tax assessment. They make their mail look urgent and official on purpose, hoping you'll panic and sign up. Don't fall for it. Real, official correspondence from your actual mortgage servicer will be clearly branded and will never use high-pressure, scare tactics. When in doubt, shred it. Your real servicer will communicate with you through the secure online portal you already set up. Okay, let's fast forward. You've weathered the storm of junk mail, your autopay is set, and the first few payments have gone through smoothly. You're getting into a rhythm. Then, about a year in, you get another official letter. This one is real, and it says your monthly payment is going up by $100, maybe more. You panic. Did the bank change your interest rate? Is this a mistake? Welcome to the wonderful world of the annual escrow analysis. Remember pity, principal, interest, taxes, and insurance. Your lender doesn't just trust you to save up and pay your property tax and homeowner's insurance bills on your own. They're on the hook if you don't. So they collect 1/12 of the estimated annual cost for those two things every single month, along with your principal and interest. They hold that money for you in a special account called an escrow account. When the big bills come due, they pay them on your behalf from that account. The key word there is estimated. When you first closed, the lender was using an estimate for your taxes and insurance. But what if the county reassessed your home's value and your property taxes went up? What if insurance premiums in your area increased due to a storm? Suddenly, the amount they've been collecting from you each month isn't enough to cover the actual bills. You have an escrow shortage. So the lender does two things. First, they have to make up for that shortage. They might give you the option to pay it in a lump sum, or more commonly, they'll spread that shortage amount over your next 12 payments. Second, they have to adjust your monthly escrow payment going forward to match the new, higher costs. So your payment goes up to cover the past shortage and the future, higher bills. Can be a shock. But it's a normal, if unpleasant, part of homeownership. The good news is, it can also go the other way. If your taxes or insurance go down, you could end up with an escrow surplus, and your lender will send you a check for the difference. While you're dealing with the financial realities, don't forget to take advantage of the perks. One of the biggest and most overlooked is the homestead exemption. This is a legal provision in most states that can save you a significant amount of money on your property taxes. It works by exempting a certain portion of your home's value from taxation. For example, if your home is valued at $300,000 and you have a $50,000 homestead exemption, you'll only be taxed as if your home were worth $250,000. This is free money the government is offering you just for living in the home you own. But here's the catch. It's almost never automatic. You have to proactively apply for it, usually through your local county property appraiser's office. There's a deadline each year, and you'll need to provide proof of ownership and residency, like your deed and a driver's license. So many new homeowners miss this. They just assume it's taken care of. Don't be one of them. The day you close, put a reminder on your calendar for the following January. Apply for homestead exemption. It's a 10-minute task that could save you hundreds or even thousands of dollars every single year. This is the new reality. You're no longer just a resident, you're a manager. You're managing payments, managing taxes, managing insurance, and managing the property itself. But with that responsibility comes a powerful shift in mindset. Every single month, when that automatic payment leaves your bank account, you're not just paying for a roof over your head. A small portion of that payment, the principal, is going directly toward owning a little bit more of your asset. You're paying yourself. Log into your mortgage portal and look for the amortization schedule. It's a giant chart that shows you, payment by payment for the next 30 years, how much of your money is going to interest and how much is going to principal. At the beginning, it's painful. Feels like almost everything is going to interest. But slowly, painstakingly, the balance shifts. Every payment chips away a little more at that mountain of debt. You are building equity. You are turning your largest liability into your greatest asset. You've survived the closing, you've set up the payments, and you've navigated the first year of surprises. You've laid the foundation. But this is a 30-year marathon, not a one-year sprint. How do you accelerate the process? How do you use this new asset to build real life-changing wealth? And what are the hidden traps that trip up homeowners in year 5, year 10, or year 20? Building the foundation is one thing. Building an empire on top of it is another. That's because getting the keys isn't the finish line. It's the starting pistol for the real race. The race to financial freedom. For the first few months, you'll be focused on unpacking boxes and figuring out which light switch controls what. But once the dust settles, a critical choice emerges. You can be a passive homeowner, someone who just pays the bill every month and hopes the value goes up. Or you can become an active wealth builder, someone who understands that this house is no longer just a place to live. It's the most powerful financial tool you've ever owned. The foundation of this tool is equity. Equity is the magic word. It's the portion of your home that you actually own, free and clear. It's the difference between your home's market value and your remaining mortgage balance. In the beginning, your equity is just your down payment. But every single month, with every mortgage payment you make, a little more of that payment goes toward the principal and your equity grows. The market appreciates and your equity grows even faster. This growing pot of gold is the engine for everything that comes next. So how do you use it? The most common tools are a home equity line of credit, or HELOC, and a home equity loan. A home equity loan is simple. You borrow a fixed amount of money against your equity, and you get it as a lump sum. You pay it back with fixed monthly payments over a set term. It's predictable and stable. A HELOC is different. It's more like a credit card secured by your house. The bank approves you for a certain credit limit based on your equity, and you can draw from it as you need, pay it back, and draw from it again during a specific draw period. The interest rates are usually variable, so it's less predictable but far more flexible. Now, here's where most people go wrong. They see that equity and think vacation, new car, fancy dinners. That's using your most powerful asset to buy depreciating liabilities. It's like taking the bricks from your foundation to build a birdbath. The strategic wealth builder sees it differently. They use that HELOC as a down payment on a second property, a rental. Suddenly, their primary residence is helping them acquire a cash-flowing asset that someone else, their tenant, is paying off for them. That is how an empire begins. Or they use a home equity loan to do a major kitchen and bathroom renovation, strategically forcing appreciation and increasing the value of their home by far more than the cost of the loan. They aren't just spending money. They are investing it back into their primary asset to make it even more powerful. The second major tool in your post-closing arsenal is refinancing. Refinancing is simply replacing your current mortgage with a new one. The most obvious reason to do this is to get a lower interest rate. If rates drop a percentage point or two from when you first bought, refinancing can lower your monthly payment and save you tens of thousands or even hundreds of thousands of dollars in interest over the life of the loan. It's a no-brainer. But that's just level 1. Level 2 is strategic refinancing. Let's say you've been paying your 30-year mortgage for 7 years, and you've gotten a few raises at work. You can refinance from your 30-year loan into a 15-year loan. Yes, your monthly payment will go up, but you'll be out of debt a decade and a half sooner, and the interest savings are astronomical. You're literally buying back years of your life from the bank. Level 3 is the cash-out refinance. This is where you refinance your mortgage for more than you currently owe, and you get the difference in cash. It's another way to tap your equity. Again, the same trap applies. Don't use it for a shopping spree. Use it to pay off high-interest debt like credit cards or student loans, consolidating everything into one lower interest payment. Or use that cash as the capital to start a business. You're leveraging the roof over your head to build a new financial future. But with these powerful tools come hidden traps. Refinancing has a dark side. Every time you refinance, you pay closing costs, typically 2 to 5% of the loan amount. If you're not saving enough on interest to offset those costs quickly, you're losing. And here's the biggest trap of all: resetting the clock. Imagine you are 10 years into your 30-year mortgage. You've made 120 payments. You decide to refinance to get a slightly lower rate, but you get another 30-year mortgage. You just turned your 30-year loan into a 40-year loan. You might have a lower payment, but you've just signed up for an extra decade of paying interest. The bank loves this. Always do the math. Sometimes the best move is to stick with the loan you have and just pay extra on the principal each month. And the traps don't stop there. Over the long haul, other dangers emerge. The first is payment creep. You got a fixed-rate mortgage, so you think your payment is fixed forever, right? Wrong. Your pity payment, principal, interest, taxes, and insurance is not fixed. The P&I are, but the T&I are not. As your home's value goes up, your property taxes will almost certainly be reassessed and increased. Your homeowner's insurance premiums will rise over time due to inflation and risk. So that comfortable payment in year 1 can feel significantly tighter by year 10, and you need to budget for that. The second long-term trap is the silent killer: major maintenance. A house is a living, breathing thing, and its parts wear out. The roof, the HVAC system, the water heater. These aren't if they fail, but when. A new roof can be $15,000, $20,000, even $30,000. If you haven't been setting money aside every single month in a dedicated home maintenance fund, many experts recommend saving 1% of your home's value annually. Then a failed furnace in the middle of winter becomes a 5-alarm financial emergency, forcing you into high-interest debt to fix it. This is how a house can turn from an asset into a money pit. Finally, there's the psychological trap of lifestyle inflation. You bought the house. Now you feel you need the nicer car to park in the driveway, the more expensive furniture to fill the rooms. You start hosting more parties, spending more money to keep up with the new neighborhood. Your single biggest asset becomes the justification for 1,000 small financial leaks that sink your ability to build real wealth. Avoiding these traps and using these tools correctly is what separates the person who is house rich, cash poor, from the person who is genuinely wealthy. It requires a mindset shift. You are no longer just a homeowner. You are the CEO of your personal balance sheet, and that house is your primary asset. Your job is to make it work for you. By paying down your principal aggressively, by leveraging your equity intelligently, and by planning for the inevitable long-term costs, you transform a mortgage from a 30-year liability into a 15-year launchpad. And then one day you'll make the final payment. The lien will be released. The bank will send you a letter and you will own it outright. That monthly payment you've been making for years is now gone. Forever. That money, $2,000, $3,000, $4,000 a month or more, is now yours to command. It can be supercharged into your retirement accounts. It can fund your travels around the world. It provides a level of security and peace of mind that is impossible to quantify. That is the end game. From the first credit check to the final closing document, this entire journey, this entire 10-part series has been about one thing: giving you the blueprint. It's not just about signing the papers. It's about understanding the system so you can make the system work for you. You've learned how to prepare your finances, how to choose the right loan, how to navigate the emotional roller coaster of underwriting and closing. And now you know what to do after the keys are in your hand. You have the knowledge to turn a simple home purchase into the cornerstone of a financial legacy. This was never just about a mortgage. It was about taking control. It was about building a foundation not just of concrete but of a future you design, a future you own.